Hey traders, welcome to Charts and Coffee. Happy day after 4th of July. Welcome to the month of July. This is where we could argue that the month really starts. Monday we had that half day, and it really wasn't a session that was anything more than kind of phoning in the requirement of two weekdays of trading not being closed. Hope everyone had a great 4th, or at least a relaxing one. Until, of course, the fireworks went off. So those of you with dogs and cats, I sympathize. It's probably the second worst day of the year, right, for our fur babies. But anyways, we're back at it. We've got a short week, but it's not without its own fireworks. We've got the OPEC meetings all day long. Today we've got factory orders at 10. Not a big deal. We do have 2 p.m. FOMC meeting minutes. What could be interesting about that FOMC meeting minutes event is we're still speculating, not on July, right? We're expecting that rate hike in July. But then the question becomes, are we going to see the second hike after July or not? Are we going to go to pause? Are we going to go into another hike? And right now it's looking like a pause. Forget cuts. It's looking like cuts are off the table for this year. You know, a question that I get a lot of is, Rog, why do we care what they are or aren't going to do? Or I get the absolute opposite, which is, of course they had to hike. Gang, trading is not in the prediction of what the Federal Reserve is going to do, or in the prediction of what earnings are going to do, or in the prediction of what data or anything else. We can't predict the market. I know, newsflash, right? We can't predict the market. But what we do is we continue to take advantage of those little adjustments along the way. That's where trading is done, right? So if anyone were to say, well, of course they were going to hike, what's the trade, right? And I'll get that every now and then, right? The Federal Reserve had to hike, and someone will go on some tirade about what has to happen. My answer is, where's the trade? If hiking is typically considered to be a bearish thing, well, it ain't working out that way, is it? Right? You take a look at where we are in terms of this year. We're very much off the lows, and we're continuing to make new highs in the S&P and the NASDAQ and tech and communications and consumer discretionary. So those things are interesting talking points. They have nothing to do with how we put our capital to work. All right, well, what about then bonds, right? If we have a hawkish Fed, and remember, in August, we were thinking maybe 3%. Here we are in August of 2022 to about October of 2022, it was 3.5%. Here we are 2 full percentage points, or 200 basis points north of that. But what's happened in the interim? The markets have gone up. Yeah, bond yields went down a little bit, but they're certainly far from a downtrend, and they're stable. So again, please avoid that whole I have to predict the market, or even worse, the ego play of this is where the markets are going in X months. And whether that be calling some new low, whether that be calling some new high, it's equally, frankly, not going to get us to where we want to go. So why do I keep an eye on the FOMC at 2 o'clock? It's a hot zone. There's going to be a volatility event. We have volatility zones, whether intraday with our HPMRs, or end of day, or even a 1 hour time frame with our DPMRs, both of which, by the way, are on sale for the remainder of, I believe, this week. And so now I know, all right, if this event's going to happen at 2, I'll start looking for those volatility moves at literally 2 o'clock plus 10 seconds, right? So I hope that makes sense. I get a lot of emails and questions like that. Why do we care about the macro? Because we're always interested in those little adjustments along the way, and that's where the trades are made. All right, so with that being said, gang, let's go ahead and jump into our questions. And first up is Editor, who asks, I have Nike. Yep. Okay. I have Nike stocks that are underperforming. Yeah. Editor, I'll tell you, I had Nike too, cut it loose. Yeah. We cut that loose some time ago. It really is probably the laggard of the top 11 one of the top 2 or 3 laggards within the consumer discretionary. So it is definitely underperforming. Agreed. I'm looking at selling and buying XLY for a long position. So there's a couple ways you could go with XLY. Let's look at it this way. Editors, crack it open to the XLY multi-chart, which is to say the index is in the upper left-hand corner, and then we have the top 11 names after that. I mean, there's a lot more to like than not. Nike's an underperformer. Starbucks is an underperformer. McDonald's is an underperformer. O'Reilly's and Booking. But what's performing? Amazon, Tesla, Home Depot. And as long as those three are moving up, XLY will move up, especially Amazon and Tesla. So XLY is a cool way to do it. If not, keep an eye on Amazon, keep an eye on Tesla, keep an eye on Home Depot, Lowe's, TJ Maxx, Chipotle. Those are all valid ways to engage what is this risk appetite in consumer discretionary. Keep an eye on the option chain on XLY, or unless you're buying shares of XLY, probably around 170 is as close as I can think I would engage to the long side. 170, maybe down to about 168.5 on that one. Editor, that's the way I would look at it. But please remember, if you don't get the pullback there and you get the pullback in any one of these other double green names, go for it, right? Those are boats rising with the tide. All right. Let's see. Editor follows it up with, oh, very cool. Did you get the 30% off? Editor, it's on sale right now. And again, my theory is when we have a sale, I've been talking about it here for a couple of charts and coffees. If we have a sale, to me, that's that much more capital that can go into your trading account. Yeah, fantastic. I'll see you there this morning. Yes? Fantastic. Excellent. All right. Next up, where can I find, hey there, Jack, where can I find the Fed tool that people always talk about? Well, I know what I talk about. I can show you the one that I use, Jack. So the one that I use is at the Chicago Merc site, the CME. I like their FedWatch tool. This is it right here. So if you Google, just Google this, right? Because the URL is ridiculously long. So Jack, Google CME FedWatch tool. It'll be the first hit you get when you Google it. And then there's your graph of what the Fed Fund futures, which is a futures contract that trades on Chicago Merc. Here's where your graph for what is expected. And look, I've heard some babbling about how they're not going to hike in July. Gang, they're going to hike in July. There's no way Jerome Powell's going to look at July, seeing that we collectively have accepted that there's going to be a quarter-point hike. They're going to hike in July, unless something calamitous happens, right, in the next 21 days. We are going to see a rate hike in July. But then what happens after that gets far more interesting and more difficult to pin down to a hold versus hike, because it's either a hold, and that's still the most probable, and then there's a possible hike scenario of a quarter point. But we are going to see a hike in July. There's no way Jerome doesn't say, look, they're expecting us to do it. They want to do it. So, what would a tightening cycle be without the Federal Reserve going one hike too far? It's kind of how this story always ends, isn't it? So there you go. That's it. Just search that CME FedWatch tool, Jack, and it'll pop up right there. All right. So speaking of CME FedWatch tool and hikes, does this undo what's happening in terms of risk appetite broadly? Gosh, no, gang, because think about it. If we're on the, and we've been talking about it in quite a few issues of This Week in the Markets, which you can check out, by the way, at thisweekinthemarkets.com. If you take a look at the S&P and you look at the overall direction, granted, it's been led by tech, no doubt. That's why the NASDAQ continues to outperform the NASDAQ, or outperforms the Dow and the S&P. But overall, we have risk appetite, gang. And as we left Q2, and this is another topic, I believe I covered this in the Friday free video, if you haven't checked that out yet. But if you look at the way in which we have our rotation, right? If you look at the way in which we have our rotation, I always look at it this way. Rotation doesn't have to happen. Sometimes it can simply be participation. And you might ask, well, Rog, what the heck's the difference, right, between rotation and participation? And the main difference is this. Rotation is when we have pretty much risk appetite helping most, not all, right, but helping most of the sectors, even disparate ones, rally, right? Rotation, when we would be looking at the strongest 2, 3, 4 sectors for the quarter, see profit taking, hence rolling over, while the bottom, the laggard 2, 3, 4 sectors benefit from taking profit, and that profit then turns into bargain hunting. The other scenario that we had laid out in This Week in the Markets was that we would see the two lagging sectors within the S&P and the Dow play catch up to tech, and that would be financials and healthcare. And I think that's mostly what we saw, but I can't say we saw a tremendous amount of rotation into what would have then been the underperforming sectors, right? They're all dividend yielding sectors. They were all sectors that would be considered more on the defensive side of things. And I did not see that big defensive move, gang. I saw some risk appetite going into the second half of the year. So this is another kind of related story to the Fed in that, look, they're not killing the market. They're not killing risk appetite with the hikes. In fact, we could even say that if they hike too far and hit that tripwire, putting the U.S. into recession, that would be bullish for the stock market as well, because it would force them to pivot. They'll do that. They'll pivot on a dime and start cutting rates. Stock market loves that. And also it'll increase labor productivity. So either way, it's really tough to see. Again, knowing what we know, it's tough to see a path to the downside, except for that CRE narrative that I've talked about on and off, which is, are we going to see any kind of commercial real estate crisis hit the regional banks? That contagion hit the financials, and that financials contagion hit the Dow, then the S&P, and then ultimately the NASDAQ. We've seen this. It would look like the March sell-off, probably pretty similarly. So if you're wondering what would that look like if that CRE crisis hits in the second half of the year, just look at the way, play by play, right, candle by candle, what happened in March with the regional bank crisis. It'll probably look a lot like that. All right, so moving on to, can I talk about how I use the Darvis ranges? Jack, I don't really use the ranges as much as I use the Darvis, and you can see those here with the yellow and purple or magenta, whatever colors you want to call these things. I just use them as automated support and resistance, Jack. I don't look at the ranges per se. I'm less interested in the box itself, and I'm more interested in the automation of the support and resistance that they require, the process, unbiased, repeatable, completely systematic. So I look at that. And if I'm looking at support and resistance, I don't use trend lines. I'd rather use anchored volume weighted average price. You say, Rog, no trend lines on your chart. I'd rather use a VWAP, an anchored VWAP. Rog, you drawing support and resistance? Nope, I'll let the Darvis take care of that. Where are your support and resistance zones? I'll let the price movement ranges take care of that, right? What's overbought and oversold? I'll let the stochastic, the slow stochastic, take care of that. So that's just one more layer of automation, Jack, that we use in the room to say, look, I want to take me and my opinion and my biases out of it and put the automation of things that I've already tested for the better part of, in some cases, 20 plus years, and let that automation take care of it. So this way, all I need to do is, as they say, read the tea leaves and go from there. So big thing about automation is, for an experienced trader, which I know quite a few of you are, for an experienced trader, it just decreases the subjectivity of our analysis and increases the accuracy and the speed at which we can make a decision. And then for new traders, it removes a lot of the learning curve, right? It makes trading and that process of not just trading, but the process of analysis that much easier, because, well, we're automating things that otherwise you would have to train your eyes to do, or you'd have to develop the skill set on top of then knowing what to do with those levels. So to me, the automation is just a win-win, regardless of where you are in terms of your trading experience. So, all right, next up, let's see here. What kind of software? I'm going between Thinkorswim bags and TradingView. Yeah, if you're looking at the two charts, the charting that I use. This is TradingView, right? This is TradingView, and I love this platform. We'll be using this a lot more in Charts and Coffee, and this is Thinkorswim. So I go between these two platforms, these two charting softwares. All right, Bags. All right, next up is, let's see, is there extra significance when the Darvis high or low is in or near the upper? Oh gosh, yeah, Pete. So that to me is stacking or layering or different types of confirmation. So if I have a Darvis level, which is a price-based level, even though it's a price pattern, it's a price-based level, right? If I have a price-based level stacking with a volatility-based level, fantastic. I've got two factors that are corresponding in a similar zone or layer, right? So 4 factors. Time is probably the most ignored. Price is the one that's followed the most. And then you've got volatility and volume. If I have a Darvis in a volume level, it could be a volume ledge, it could be a VWAP, it could be a V-score reading, same thing. So if any of those tools are overlapping, notice I've got an anchored VWAP in my 200 propulsion. Fantastic. So I look for different things to kind of plot in a very tight area. And that tells me there's multiple analysis that's going to say, hey, that's significant. It could be price-based, volume-based, volatility-based, whatnot. So yeah, there's extra significance. Absolutely. But it's not just a combination of DPMRs and Darvis. It could be Darvis and an HPMR. It could be Darvis and a propulsion. But I'd rather it be Darvis and some sort of volatility tool, or Darvis and some sort of volume tool. That's usually ideal. Is this the Darvis box on Toss? There is a built-in one, Benny, but the process that I use is different than Toss. If you were to use the Darvis 2.0, as I call it, and you use Toss's version, they are going to plot in different spots. Here's the good news. The Darvis 2.0, we've made available free since, 2016 or so, 2016 or 2017. It's been many, many years. So Darvis 2.0 is available on Toss. It's available on TradingView. And if you want to grab the Toss version, I believe you can download. Look, if you're a member of one of our rooms, my Sector Secrets Mastery, of course, Futures Room, Options Room, I have a layout that I share with members with the free tools. But if you're not a member yet, you can still go grab it. Head on over to Countdown Trader. Hang on, let me show you what I mean in case any of you out there saying, okay, Rog, that's cool, but I'm not a member yet. That's all right. Head on over to countdowntrader.com. And then I believe, there it is. Go check out the free downloads. All right. So you can download it from countdowntrader.com. And while you're there, check out the recent updates. Trish is always distilling what we're doing in the mastery, what I'm doing in my personal trading, recap what we're doing in the mastery. She's always distilling that stuff to what's going on right now. Questions like, is the NASDAQ too high? Rog, is it? Not in my opinion, but check out why, right? So if you haven't been to the Countdown Trader before, it's just a blog where I say it's just a blog. It's actually a fantastic resource for new and experienced traders who are getting used to how I look at the market. Right. Okay. Let's see. Sergio asks, where did I learn to trade? Completely self-taught. Did I work at a hedge fund? Heck no. No, gang. Yeah. Just believe me. You don't have to be a floor trader, fund trader. No. You can be self-taught. There's plenty of self-taught retail traders out there. I'm self-taught. Yeah, I'm self-taught. And it just takes some time, some dedication, and a lot of market observation. I think like a lot of things, you put the time in. Yeah, I don't believe in 10,000 hours, but you put some time in. This is definitely a learnable skill. Yeah, no doubt. All right, gang. And just like that, time's up. Thanks as always for being a part of Charts and Coffee. All right, caffeinate and dominate. This shortened week, we still have non-farm payroll, FOMC meeting minutes, a lot more data to come. All right, gang. Be good to each other. I'll talk to you tomorrow.